In October of 2021, the annual rate of inflation in the United States reached 6.2%, the highest level in more than 3 decades. Other inflation indicators have also increased significantly in recent months. What is happening, you may be asking? Is this the start of a worldwide inflation? In this video, we will discuss a little important history on U.S. inflation, the reason behind the recent rise in inflation in the U.S., and how the U.S. interest rates affect the international markets. Make sure to watch until the end because the last point in this video will enlighten you. First, let's begin with a brief history of inflation in the United States. Inflation is defined as a widespread rise in the price of goods and services and a decrease in the buying power of money. Let's start with the discussion about a time known in U.S. history as the Great Inflation. The Great Inflation defined the second half of the 20th century's macroeconomic history. It prompted economists to reconsider the Fed's and other central bank strategies. The post-World War II global monetary system was abandoned. 4 economic recessions occurred, 2 major energy shortages occurred, and wage and price restrictions were implemented for the first time in peacetime. Inflation peaked above 15% in March of 1980 and decreased to pre-Great Inflation levels of 0 to 5% by December 1982. Numerous governments pursued monetary strategies that claimed to move the Phillips curve upward, so improving the unemployment-inflation nexus. As global commerce increased, demand for U.S. dollar reserves increased proportionately, and foreign central banks collected an increasing amount of dollar reserves. At some point, the quantity of dollar reserves held overseas surpassed the U.S. gold stock, signaling that the U.S. could not sustain total convertibility at the current gold price. President Nixon prohibited foreign governments and central banks from exchanging dollars for gold in 1971. The Federal Reserve adopted an even-keel policy in the 1970s, in which interest rates were maintained and stayed constant between the announcement of a Treasury issuance and its sale to the market. As debt problems grew more frequent, the Fed's commitment to the concept imposed greater constraints on its ability to conduct monetary policy. Energy crises that repeatedly boosted oil prices and stifled the U.S. economy were a more disruptive influence. During the Great Inflation, officials almost certainly underestimated their policy's inflationary consequences. The Phillips curve, whose stability was critical to the Federal Reserve's policy choices, started to fluctuate. As companies and people developed an appreciation for and even an expectation of increasing prices, any trade-off between inflation and unemployment became less attractive. This eventually became known as the stagflationary age. There was a widespread perception that confronting inflation head-on would have been much too expensive to the economy and employment. Between 1971 and 1974, the Nixon government implemented wage and price restrictions in 3 stages. After designating inflation to be his number one adversary, President Gerald Ford launched the Whip Inflation Now, Win initiative in 1974. Now let's jump to 1982. Prior to the 2007-09 recession, the 1981-82 recession was the country's most severe economic slump since the Great Depression. The roughly 11% unemployment rate attained late in 1982 remains the post-war era's zenith. The manufacturing, construction, and automobile sectors were especially hard hit. Recessions were sparked by tight monetary policy in an attempt to combat rising inflation. Paul Volcker was selected Fed chairman in large part due to his anti-inflationary ideas. He was certain that the Fed's top concern should be rising inflation. Volcker changed the Fed's policy away from interest rates and toward actively targeting the money supply. The new approach was intended to demonstrate to the public that the Federal Reserve was serious about achieving low inflation. Volcker's first effort to contain inflation and inflationary expectations failed. The Carter administration's credit control scheme, which began in March 1980, produced a severe recession. As unemployment increased, the Fed relented, evoking the stop-go practices that the public had become used to. By October of 1982, inflation had declined to 5% and long run of interest rates had begun to decrease. Now, you must be asking yourself, what caused this current rise in inflation in the U.S., which is higher than it has been in decades? One of the greatest causes of the current inflation crisis is the coronavirus pandemic. Inflation has surpassed the coronavirus as a growing concern in the U.S., highlighting the electoral danger it presents to President Biden and congressional Democrats. But thankfully, the majority of economists anticipate that inflation will go down after the Omicron wave subsides and Americans shift their spending into services such as going on vacation, dining out, and going to the movies. Consumer prices increased by 7% last year, the most in almost 40 years, according to the U.S. Department of Labor. The jump was fueled by price hikes for housing and used automobiles, but energy prices declined. The last time prices increased at this rate was in the summer of 1982, when the economy began to recover from the 1970s double-digit hikes. High inflation is a significant impediment to reviving the labor market. Prices for automobiles, gasoline, food, and furniture have increased significantly since the economy has taken a big hit from the pandemic recession, a time when the government has been supplementing people's income as well as bailing out important companies. As Americans increase their spending, supply lines have been strained by labor and raw material shortages. Consumer demand is driving inflation, as are growing salaries. Used vehicle prices have increased 37% in the last year because of a semiconductor scarcity. Jerome Powell, chairman of the U.S. Federal Reserve, said the central bank erroneously thought supply chain constraints that have contributed to the rise in commodity prices would not linger as long as they have. Powell admitted that supply constraints had remained. Now, the Federal Reserve is discontinuing its monthly bond purchases, which were designed to decrease longer-term interest rates in order to stimulate borrowing and spending. The United States is a large country, and it has a great impact on the interest rates of worldwide markets. So how does all of this affect the international markets and the global economy? The degree to which the global economy's destiny is determined by the performance of the U.S. economy is never more obvious than when the Federal Reserve does something unexpected, even if it is just a slight surprise. People were surprised when in June of 2021, the Federal Open Market Committee indicated that it would likely increase interest rates by a relatively insignificant 0.5% in around 2 years. Because of that announcement, stocks fell in Tokyo and London in a matter of hours, and it was not because of the likelihood of a tiny rate hike 2 years in the future. Rather than that, it was because of what was seen to be driving it: heightened fears about increasing inflation and thoughts that the Fed is not doing enough to keep inflation from advancing to the point where extreme action would be required. Not only are the economies of the world affected by the U.S., but they are having their own struggles due to the COVID-19 pandemic. As nations battle with unequal recovery, the current bout of inflation heralds the end of an era. Spain's inflation rate hit its highest yearly rate in decades last year. Only China's inflation rate is lower now than it was in early 2020. In the years ahead, longer-term factors such as greater protectionism, growing Chinese wages, and the transition to a low-carbon economy will exert upward pressure on pricing. Inflation is forcing gas station and grocery store prices to rise. Global supply networks that are clogged are increasing expenses around the world. Increasing commodity expenses such as food and energy are having a similar effect. Import costs, particularly for food, gasoline, and industrial components, have increased by more than 10% in the last year. Americans' disposable income increased during the Great Recession as millions of them moved their spending away from restaurants and toward commodities. Household earnings increased by 16.8% as durable goods priced increased, more than 4 times the rate of rise for services. In sub-Saharan Africa, increasing petroleum costs resulted in more costly fertilizer, which increased food prices. The European Central Bank is concentrating its efforts on bringing monthly asset purchases down to 20 billion euros. According to BlackRock Investment Institute, inflationary global dynamics are expected to persist. The Biden administration is supporting the reintroduction of critical supply chains to the U.S., which would almost certainly result in an increase in manufacturing prices. Increased U.S. interest rates are expected to divert money away from emerging nations. Unless they increase their rates to match the U.S., they will suffer from slower growth and severe negative side effects from the Fed's tightening approach if they do. An increase in U.S. interest rates might have a negative impact on vulnerable nations as well. Developing countries should ready themselves for a slew of Federal Reserve actions. Currently, prices are growing at the quickest rate in almost 4 decades in the U.S. Increased inflation in the U.S. might prompt a more aggressive reaction from the country's central bank, causing financial markets to tremble. The International Monetary Fund has cautioned that the United States Federal Reserve's plan to hike interest rates in 2022 might rattle financial markets and tighten global financial conditions. The IMF forecasts lower U.S. inflation later this year, but caution that broad-based increases or protracted supply constraints might result in higher prices. Additionally, for economies that have issued debt in U.S. dollars, repayment will become more difficult. This is true for both private and public borrowers. It is not hyperbole to assert that the whole world is watching and anxious to learn the answer to the following question: how much is too much? What else would you like us to talk about in our upcoming videos? Let us know in the comments below, and make sure to subscribe and turn on notifications so you don't miss out on any of our videos.